This is a recent trade taken, providing a 7% gain in under 7 days, with little to no drawdown. Yes, it was based on technical analysis, but there were several other signs we received giving us confidence that price would definitely rise, and one of those major reasons is in this area. Today we are going to share with you the top candlestick patterns that every trader needs to know to predict chart directions just like this, and we will also share with you exactly how to integrate them into your technical analysis to improve your trading. Let's get right into it. Before diving into candlestick patterns, it's important to fully grasp how candles are structured. A candle comprises of the body, which is defined by the opening and closing prices. It also shows the highest point and lowest point of that candle during its formation. And finally we have the wick, which is the area between the body high and low. When looking at a chart, the way candle forms tell a story about what is happening with buyers and sellers, and there are several well-known formations that we are going to learn about today. The first formation we will discuss is called the tweezer candle formation. This candle pattern is formed when sellers or buyers begin to lose control in the market. The candle pattern is defined by two or more candles with long wicks to the downside or upside and a small body. This candle pattern is most significant when it forms during a strong trending market and will indicate a potential incoming reversal. For example, here we have price trending strongly in a downtrend and it trades down into this support area. At this point, we can see that price tried to push lower but rejected strongly and created this long wick to the downside and small bearish body. This tells you that buyers are below this area and are looking to buy price back to the upside. Then, we can see that price tried to push below the support zone several times but rejected and started printing bullish candles to the upside and price started to trend bullish. Now this is an ideal situation where the candles form exactly how we want them, but in most cases this candlestick pattern will not appear like this and instead will look similar to this. Or this. It will not always be unified. If in a bullish trend and this candle pattern is formed, it is called a tweezer top, and if in a bearish trend it is called a tweezer bottom. It is important to note that when trading candle patterns you should not use them by themselves, and they should be used alongside other analysis as we did here, or with other indicators or strategies. Next we will discuss another popular one and it's called the doji candle pattern. This is a candle pattern that signifies indecision in the market. This pattern is neither bullish nor bearish. When this pattern appears it usually means buyers and sellers are equal and price might begin to range. The pattern is defined by long wicks and a thin body. Ideally this candle pattern will have long wicks on both sides, but as with all of these candle patterns, the market is rarely ever this ideal and this pattern can have a long wick to the upside or downside or a short wick, but the defining factor here is that price opens and close at the same price, showing that buyers and sellers are equal. You will also hear this pattern referred to as a gravestone doji or a double doji, but regardless of the formation you see, this pattern will signify indecision. This pattern can be used in confluence with other patterns to determine reversals. For example, if we have price trending strongly, we have these strong bullish candles showing that buyers are clearly in control. But now we can see that suddenly the candles get smaller and now we have a doji candle. This now indicates that we are at a decision point in the market. Buyers and sellers are battling at this point and price can go either way. But right after the doji, we have this strong bearish candle, which shows that bears won that battle and price will continue to the downside. And with that, we will now explore one of the most popular candle patterns, which is called the engulfing pattern. This pattern signifies the end of an uptrend or downtrend or the start of an impulse move. The ideal formation of a bullish engulfing pattern is when the opening price of the candle must be lower than the close of the previous bearish candle, and the close of the bullish candle must be higher than the high of the previous two bearish candles. Here we have an example. We can see here we have a strong support. Price has rejected this area several times, showing that there is buying interest at this point. As price continues to reject, we can see that it also is forming a tweezer bottom, and now we have a bullish engulfing pattern. The candle is significantly larger than the other two candles and it engulfs them. We can set stops below the support and execute a buy here. The psychology behind this candle is that bulls rush into the market completely overpowering bears, and this is the start of a strong push to the upside. There will not always be a gap between the close and the open, and there will not always be a close greater than 2 previous candle. As always, that is the ideal situation. The main thing to remember here to identify this pattern is that the engulfing pattern closes in the opposite direction and is much bigger than the previous candles. Always use these patterns alongside signals or other forms of analysis. The next pattern is one of our favorites and was used in the example shown at the start of this video. But before we continue, don't forget to like and subscribe to not miss out on future videos. And if you would like to try the #1 premium indicator on TradingView, you can use the link in the video's description to test Lux Algo Premium risk-free for 30 days. Your continued support really helps the channel. This next pattern is one of our favorites and is called Morning Star for bullish formations and Evening Star for bearish formations, and is used to signify bottoms or tops in the market. Let's start with the Morning Star. The Morning Star pattern is a 3-candlestick pattern. Ideally, this is how the candle pattern should form. You have a bearish candle followed by a weak bullish candle and then a strong bullish candle that breaks the previous candle's high and signifies a bullish trend. In a real-life example, the pattern might look like this. As you can see, the pattern can sometimes have doji candles or tweezer bottoms in its formation. To identify this pattern, what you need to remember is that this pattern is usually a combination of several other patterns, which makes it stronger than most. Here we can see there is a downtrend, then we have doji candles, which signifies indecision in the market. So now we are waiting to see what price will do. Next we can see we have tweezer bottoms showing that price is failing to break below that level. And then we have a strong bullish candle, which is similar to the bullish engulfing pattern, and price reversed. And note that all this happened at a recent support level. Let's look at a bearish example, which is the Evening Star. As you might have imagined, this pattern is just the opposite. Here we have price in the upper half of the channel, so if we are trading a mean reversion strategy, we would want to see signs that price will reverse. In addition to being in the upper half of the channel, we notice this resistance level where that price has rejected several times. Now as price returns to that level, we can see that the candles start to get smaller. So this is the first 2 steps. First we have strong bullish candles approaching a level, then we have weak bearish candles or doji candles signifying a battle for control at that point, and then a strong bearish candle which shows bears won that battle. Those were some of our favorite patterns that we use in our own portfolio, but there are many other patterns which we did not cover in this video. Here are some honorable mentions. We have the hammer, which is a single candle and is a bullish pattern. It occurs after a significant downtrend. We have the piercing line, which is also a bullish pattern which has a similar structure to the bullish engulfing pattern, given that it has a gap to the downside, but in this case it does not break the previous candle's high. There is also the white and black Maribozu, the hangman pattern, and so much more. As you explore the world of candlestick patterns, you'll come to understand that a lot of these patterns are variations of other patterns, and instead of looking for a single pattern in its ideal formation, you need to understand the story being told behind candles, and how that translates to what is happening on the chart. For example, if you are looking to take a sell at the high of the RSI, you can try to read the candles to determine when bears are taking control, instead of trying to identify exactly when the formation of a bearish engulfing candle appears, as it's rarely ideal in real market conditions. What you can also do is use an indicator to help you identify some of these patterns. If you go to the Indicators tab and search Candlestick Channel by Lux Algo and add it to your chart, you'll find that you can select a number of candlestick patterns, and the indicator will locate the areas they occur for you automatically. You can also go to Technicals and click Chart Patterns, and a number of them are listed here as well. We hope you enjoyed this video on candlestick patterns and how they can be used in your trading. Don't forget, if you would like to try the top premium indicator on TradingView by Lux Algo for 30 days risk-free, where you will get access to the oscillator matrix, price action concepts and signals, and overlays indicator, all developed by the top developers on TradingView, the link is in the description of this video. Don't forget to like, share, and subscribe, and we will see you again in the next video.